My name's Declan McEvilly, co-founder at OnePlanetCapital. We are a specialist EIS investment manager and a slightly newer proverbial kid on the block. And we've been going about 5, 6 years now. And like I said a moment ago, and Brian's alluded to, we are a specialist manager. What we do, everything that all the businesses we invest into, all of the funds, all of the strategy, all of the due diligence is focused through our lens surrounding our investment thesis, which is all around combating climate change. So our investment thesis is that we're investing into early stage businesses and technology that are tackling the world's largest environmental issues. So we're really honing into that climate technology sector. Now, we're doing that really, I would boil it down to two core reasons. The first is that we do generate a positive environmental impact via our investments. We do have the FCA Sustainability Impact label. Now, naturally, that appeals to a lot of investors that are more ESG leaning or more impact leaning, and we can demonstrate that. And I think it's quite difficult to get the sort of impact that we are achieving in your wider listed portfolios, being sort of boots on the ground, as it were, and your clients' money really supporting new technology that is driving changes in climate impact is really important for some investors. That's the first reason. I would argue not the main reason that we're in this sector. I would say unashamedly that I'm a capitalist and I'm here to make money for myself, for you, and ultimately our clients. We just so happen to believe that actually businesses and technology that makes things more efficient, reduce carbon, reduce fuel usage, reduce electricity, have the ability to generate large returns for clients as well. So in early stage impact investment, I truly believe, although take it with a pinch of salt, that you can have your cake and eat it at the same time in terms of getting impact, but as well actually generating returns for your clients as well. So that's what we're doing. So today really is just to try and shed some light on why we're in this space, to try and get people excited about sort of early stage climate tech investing and give you a flavour of who One Planet Capital are. So I've kind of mentioned this up front, but we think this sector of climate technology is really exciting from an investment perspective. The main reason is because we are on a transition to a green economy. This is happening, regardless of sort of what political power is sort of leaning in the US. Globally, we are making an impact on our carbon reduction. Last year, the EU produced 8% less carbon emissions than it did the year prior. So we are making change here. This is happening. Now, whether you are ESG leaning or not, what we want to invest into are businesses that make things more efficient. It just so happens that efficiency is a reduction in carbon, reduction in fuel, reduction in electricity. That is just good business sense. That's why we really like this sector. We think there are sort of four core main drivers as to why this space has got legs. Firstly, is that most people now recognise that there is some form of climate emergency. That's relatively widely understood, and people are generally happy and on board with that. The second thing is that we're starting to see governments legislate towards net zero, and we're starting to see that at an increased rate. And really interesting in the last few years is the way in which we're legislating is changing. So for a long, long time, particularly in this country, we have a target objective of being net neutral by 2050. I personally don't think that target objective has driven a huge amount of change. It's been a very nice thing to talk about and a very nice thing to sort of target towards. However, a small to medium-sized business owner, the last thing on their mind is what the objective is in sort of 20, 30 years' time. But what we have seen is that change. So we've come down from a government pledge or government target objective to when we're starting to see much, much more sector-specific regulation, and that is driving change. So, of course, we're probably all aware of this. We've got the ban of the sale of petrol diesel cars coming over the hill in this country by 2035. There's a piece of regulation in the retail space called the Enhanced Producers Responsibilities Act, which is all around large-scale consumers and the amount of plastic packaging they use. So corporates are starting to look at their plastic packaging supply chain and seek solutions, because otherwise they're going to be hit with big tax bills. Like I said, the electric vehicle changes coming over the hill, that's changing the transport sector. So there's lots and lots of change that's being driven by regulation. Now, that creates an opportunity for new stage technology. New technology will be able to capitalize on these changes from these massive, massive markets. And we're starting to see that. And that's the third pillar here. The corporate behavior is changing, and corporates are desperately seeking solutions to either become more efficient, either to adhere with what their consumers want, or to adhere to these new regulations that are coming over the hill. And that's the fourth part there, is that consumers are starting to take a stance. And as long as they're price parity, I think a few years back when there was a bit more money floating around, sort of 2020, and there wasn't a cost of living crisis and interest rates weren't so high, people were willing to spend more to support sustainable causes. That's not the case now. So as long as there's price parity, people are willing to support more sustainable and climate conscious businesses. So all of that is to say is that there's a really strong investment thesis behind climate technology. If you can, take one thing away from this presentation, is that I think early stage climate investing does not just have to be for ESG clients. I think that this, as part of a wider portfolio, has its place, and there are some really exciting businesses and technologies here. So that sets the scene. So where do we actually invest? Climate technology is a very broad church now. It's been developing for a long time, and in the last few years, because of those different factors that I've mentioned, we're now starting to see some really exciting different sectors and different industries that encompass climate technology. And that's what we look to do for clients. So we deploy clients into a portfolio of climate technology businesses, all with similar characteristics, but spread across our core subsectors. And these are the sectors on screen here. So energy markets, that's probably what people most likely think when they think climate change and climate technology. Clearly, under the EIS rules, you can't invest into businesses that produce energy anymore, but you can invest into businesses that improve the efficiency of those businesses, and they improve the output of these renewable energy technologies. And we're seeing some really fantastic growth in that sector. Transport, mobility, and the logistics surrounding that is a very, very large, well-known sector within climate change. And the automotive sector is very, very well developed. It's not personally something that we get involved in. A lot of these businesses are very, very large, very well developed. However, we're seeing some really interesting change in other methodologies of transport. So marine technology, for instance, is something that we're seeing fantastic growth in. The UK, as an island nation, no surprisingly, produces some really, really fantastic marine-based technology. And there's some really great businesses there, and I'll talk about one of them in a moment. Buildings and construction being the next subsector. So this is all around new materials, new methodologies of coming up with construction materials, but making them cheaper, more efficient, and using ultimately less carbon. There's a lot of regulation capturing that subsector. Final core subsector being packaging, waste, and recycling. So this is all about reducing packaging, reducing wastage, and increasing recycling. Again, a lot of regulation in that subsector. And then the final subsector that we talk about, which is a bit broad, is wider technology. So this encapsulates a lot of software and SaaS businesses and some AI businesses as well. So again, one thing to take away is that climate technology isn't what it used to be. I think if you ask most people to think of a climate investment, certainly 5-10 years ago, I imagine most people would have said a solar farm. Now, there still is a bit of that, but there's some really exciting technology across the board here. It's not just energy, and we can build a really nice, well-diversified portfolio of different industries, different subsectors, different business models, but all with those same interesting and exciting investment thesis characteristics within their portfolio. Just a very quick one on sort of the businesses that we like to meet and how we think about our investment due diligence. Most managers will have a similar process, but just to shed some light. So we focus our investment due diligence around what we call 6 core pillars. This encompasses the team, the market, the product or the USP, making sure that that company has a clear momentum of growth and that they have a trajectory to hit revenue targets, that they have a positive environmental impact. And for the EIS fund, it's very important for us, and it's a requirement for us that they are able to give us clear, measurable KPIs on how they provide that positive environmental impact. We tend to see businesses fall into one of 3 buckets when we're talking about impact. The first being a direct removal of carbon. That's incredibly difficult. That's kind of scope 1. That's your gold standard. But that's very, very difficult for businesses to actually remove carbon. The second bucket or second scope that businesses fall into is the displacement of carbon. And this is where most businesses fall into. These are businesses that, through their natural trading activities, because they are a cleaner, cheaper, more efficient way of doing things, the alternative would produce more carbon, but because this is being used, it displaces that carbon being used. And then the third scope that we talk to is an improvement towards a more sustainable aesthetic. And these are businesses that are helping the transition. So they're a little bit more intangible. Most businesses in the portfolio fall into that scope 1. So most of the time we're thinking about displacement. And again, I'll paint that in a picture when I talk about some examples. And then the final thing, which is important for all managers, is making sure that they have a viable business model and a viable financial model. So we do have 2 funds, but I'm talking about one today predominantly, our EIS fund. We also do have an SEIS fund. So with the EIS fund, clients receive 6 to 8 climate technology businesses in each tranche. Again, similar characteristics, but spread across those core climate subsectors that I mentioned previously. We have a £10,000 minimum ticket size. The stage of investment is what we refer to as pre-Series A and Series A. So everything in the EIS portfolio has revenue at point of stage of investment. We're certainly out of the kind of a crazy idea in a shed. These are real tangible businesses at this point of which that we want to get involved and invest with them, which is really important. And then I suppose the last important thing is that we are tranche based, but because we are a little bit smaller than some of the other managers here, we do get money out the door very, very quickly. So there's a lot of really fantastic businesses in the UK in the climate technology space. There's some fantastic opportunity out there. And because of that, we were able to get clients deployed really quickly. So if anyone is considering investment this tax year, we're currently raising for our deadline of the 25th of March. At that point in time, we'll close fundraising and we will aim to get clients fully deployed this tax year. So we are good at getting money out the door and getting money invested. So just the last couple of things from me, I just want to give an example of a couple of businesses that we invest into to bring it to life a little bit. So this is a business in the portfolio called GT Wings, or what was known as GT Green Technology. These guys are trying to improve the efficiency in the cargo and shipping sector. So as you can all imagine, these great big cargo ships, massively pollutant, using huge amounts of diesel. Their issue is that they are not as efficient as they would like to be from the ship owner's point of view. So where GT Wings come in is that they have developed a bespoke wind propulsion unit for these cargo ships. You can see it on the front of the ship here. So these things are retrofits. They can be installed into pre-existing ships and they generate thrust, they generate wind propulsion on each ship. They save ship owners fuel. That's why ship owners like this technology. They've been proven on sea trials to save up to 25% of a ship's fuel usage in diesel costs. So there's a real business case for Shell, BP, Harrisbrook Shipping to actually install these units, regardless of whether you think these businesses are green or ESG or not. They certainly want to reduce the amount of fuel that they're using. So that's a really exciting business in our portfolio that's performing really well in the transport space. Another very quick example in a completely different subsector is a business called Kelpie. They are a bioplastic business. So what they're trying to do and what they are doing is developing a new plastic-like material from organic matter, in this case, seaweed and kelp. So it's a fantastic material and they're really plugging into the food and beverage market. And like I said up top, there's more regulation coming into that space. So a lot of supermarkets and food and beverage manufacturers, they are seeking new ways of developing packaging. And Kelpie is a really fantastic solution for that. And the last business that I'll speak to, again, completely different business, completely different subsector, business called EREX. These guys are in the built environment or construction business. And what they are trying to do and what they are doing is solving the energy efficiency that UK and European homes have. So UK homes have got incredibly poor ventilation. We all know this in the UK, problems with damp, problems with mold, energy loss due to poor ventilation. Most ways in which Victorian or older style homes in the UK are ventilated is what's referred to as just a dumb ventilation system, which is just a brick with some holes punched in it to allow for ventilation. And this causes all a load of problems with damp, mold, etc., etc. So what EREX has developed is the world's first smart air brick, retrofit brick, which can be installed into a pre-existing ventilation system. And what the rub is here, why this business is exciting, is that it's got adaptive ventilation systems that's adaptively open and closed based on a whole host of different conditions, such as damp, mold, temperature. And ultimately, it's been proven to save up to 12% of the UK qualifying home's energy bill. So again, it boils back to this: is there a real cost incentive for these businesses to exist? And a lot of times there is, and that's exactly what we like to see, coupled with, does it improve? Does it reduce electricity usage? Does it reduce fuel usage? And does it combat the changing environment that we're seeing? So look, that's my quick summary. Just to cap it off, we are a specialist manager focusing on climate change and climate technology. I do think that there's inherent diversification within this space, and I don't think this is just for ESG clients, although that naturally appeals to some of them. That's me.
Hey, Declan, thank you very much for that. Some super exciting things going on in that space. Some of these questions I think you've covered off already, but I think there's definitely worth going over some of these. Going on to some of those examples you showed, what particular areas excite you most from an investment perspective in terms of heading towards the battle to combat climate change?
Yeah, it's a really good question. So a really new, exciting subsector that we're seeing sort of verge over the hill at the moment is called climate adaptation. So there's a whole host of businesses and technologies that are effectively saying, right, the planet is warming and there are going to be consequences of that. There's flood risk, there's all sorts of things. And this causes issues for everyone. But most of all, the businesses that are are multinational. So there are businesses that are now developing to say, right, how do we actually prevent, adapt, and actually, come up with solutions for this crisis? So preventing and helping adapt rather than just reducing emissions. And there's some really, really interesting businesses in that space.
Excellent. Questions just come in. Do you exclude fossil fuel companies?
We do, yeah. So we have a strict mandate that everything has to have a positive environmental impact. If a business, so it would naturally be excluded if it was fossil fuels.
Perfect. You mentioned earlier about the political climate.
Yeah.
Mr. Trump, has he made the climate change agenda a more difficult sell?
Yeah, it's yes, in a word. Not to beat around the bush, he has. I think there's definitely been a reneging. What I've actually seen is a slight pendulum shift, I would say, away from broader ESG, based not just on Trump, but I think a whole host of different things. My kind of rebuttal to that is that we're not ESG. We are trying to and do invest into tangible businesses that solve a business case. I would argue to anyone that's a climate denier or doesn't give a flying monkeys about the climate, that businesses that like GT Wings that they save emissions, they save costs. That's just a robust business case. It just so happens that it's reducing carbon. But look, demand certainly has sort of fallen, particularly in the retail space, and I think that's mainly captured around ESG, the ESG issue. I mean, if you look at institutional fundraising in UK and Europe, climate technology is a bulwark. It's a really, really massive sector within institutional venture capital markets, but doesn't often get replicated in the retail space.
Perfect. Thank you for that. I see Brian's appeared again, so I guess time's up. I'll hand back over.